We just witnessed $1 trillion leave the software sector. And in the meantime, the U.S. set up accounts to give $1,000 to every baby born from 2025 to 2028. The dollar is starting to strengthen back up and maybe stabilize that level. Gold has shot up and down all around the place. Silver's taking on a meme stance. And diversification seems to be winning right now. Those are just some of the things I want to talk about with you this week while we sit back and chat. Before we get started, I just want to let you know that I do have a great tool for budgeting that I use myself and with some of my clients, Monarch Money. It allows us to interact together in real time. They can share their budget with me. They can take a second and look. Just so you know, if you want to check it out, there'll be a description and a link below. If you use it, I may be compensated if you use the link I provide, but check out Monarch Money when you get a chance. Hop on your laptop and give it a look. Monarch Money, once again. So, like I said, it's been a wild beginning to 2026. What's up is down and what's down is up. The turmoil has been there. What caused this $1 trillion liquidation that I spoke about earlier? It was Claude, the acceleration of Claude. Right at the beginning of February, on Friday, Claude introduced a bot that could eliminate a lot of just legal type work, a lot of assistant type work that you could be done, paralegal type work, I guess I would say. And that began a drastic shift from software. It was already starting a little bit, but that really accelerated. And later this week, we saw such things as Claude come out with an agent that they said is more advanced, that they can use for more than just legal work. And we saw the real deluge in software. Despite of strong earnings reports from some of the some of the hyperscalers, Microsoft, Amazon, Apple reported in these last few weeks, one thing that we saw consistent was that their capital expenditures, their CapEx, was going up. The markets didn't seem to like that. We'll note that speaking today, Jensen Huang, CEO of NVIDIA, mentioned how revolutionarily large this expansion is, and that we've never undertaken an endeavor like this in the history of the world to create something that requires this much, and how transitional it could be. I know people say he has a slanted view on it, as like I said, he's CEO of NVIDIA, but he also has an inside peek that most people can't see. So let's just assume that the AI build-out's happening, even if it's not the same capacity or scale that we thought it was. And what we saw with the software shift is an example of that. It's actually healthy when you see, just because something says AI, that it doesn't just keep going to the sky. The markets were waiting for explanations into these capital expenditures by these major hyperscalers. They want to know why these dollars are going and what's going to be the return on investment. Note in this video that I may mention some companies, but these aren't companies that I'm not giving any investment advice for individual companies. That's a more personalized conversation. But like I said earlier, these hyperscalers such as Amazon, Apple, Microsoft, they were explaining that they were going to spend a lot of money investing in AI. Some estimates have them spending as much as $2 trillion just from the largest companies combined in the next couple of years in capital expenditures in the AI. What will be the return on that investment is the big question that's haunting a lot of people. Back to the SaaS. So the SaaSpocalypse. People may not know exactly how that model works. So you have a company that has enterprise and scale sitting there, and you're paying per seat. So let's say you're paying $10 per seat for someone to use your service, and it's all stored up in the cloud, the mysterious cloud. Before, things were, you would get a system, you would have maybe a CD or a disc that would have a system that everyone could use one time charge. It would be way more than whatever the cost of $10 per head would be. It would just be a one-time cost. But that was a static tool. It didn't move with the times. If something changed, you had to go get a whole nother system, a whole nother disk. With the way the world works now, and this information in the cloud and dynamic tools and the way that it moves, you can pay $10, $15, whatever you pay. The numbers are arbitrary to have an agent per seat. So it was a per seat model. But what AI is doing with these agents that I mentioned earlier is coming in and eliminating the number of seats that these companies potentially need. We see this in the housing market with recent grads. We see this in the job labor market with recent grads struggling to find entry-level jobs because they're being eliminated by AI. This is a disruption of the job market. People have to figure out the tools they need to use this AI and integrate it into their lives. So, like I said, that was the worry with the SaaS models. So you saw companies like Salesforce and Accenture, Workday. Once again, non-investment advice. We're telling you buying these companies, just telling you what you saw and why they went down, right? Because people saw that you wouldn't need as many agents anymore. People assume you won't need as many agents anymore. But even at these levels that we saw this sell off, it probably was oversold based on one measurement called, well, many measurements, but one measurement called RSI, relative strength. So you generally, once that reaches like a stock reaches like 30, that means it's pretty oversold. Some of these stocks are in the 20s. So that means some of these major cap stocks there are some of the greatest companies in the history of the world. So do your own research, but there may be some opportunities inside of that if you want to see growth. Just more to say that SaaS and software was probably oversold. In the same area, we saw the software ETF, which also has a good bit of cybersecurity in there, which was also hit hard in this recent sell-off. We saw it down like 24% to begin the year. Whereas compared to the hardware, so think of the Taiwan Semiconductors, NVIDIA, the people who actually make the chips, Intel, AMDs of the world, which were under pressure some as well, but they've been up 7%. That index that measures that has been up like 7% this year. So you have like the largest gap, about 30% gap that you've seen in between semis, software, pretty much as far as they've been reporting those ETFs. So it's a pretty huge divergence. With that being said, it's not the end of the world. It's there are other opportunities inside of AI. That's one thing people need to realize. The concentration and winning of just the Mag 7, those days are probably over. You need to just look for other opportunities, perhaps in some chip makers who make chips for, I don't know, maybe they make chips for cars, or they make chips for your laptops, or they make chips for some of the smart devices inside your home. It doesn't have to always be some of the hyperscalers or Apples or Microsofts. There are plenty of opportunities outside this market, outside of tech for investments in this market. Next, let's jump into the dollar. So the dollar has been the reserve currency of the world for a long time, right? Even when we went off the gold standard back in the 70s, we still had the dollar as the number one reserve currency in the world. How does this work? People aren't running around with bags of dollars, right? Pretty much what it is a debit and a credit on the balance sheet. So countries want to invest in dollars. Think of it as a casino, right? Since we're in Super Bowl, it's Super Bowl time. Think of it like a casino. Take your money into a casino. You want to play with your chips. You have to take your money, go to the cashier, exchange your money for chips. Then you can go play wherever you want to play with those chips. And then you have to come back and you can cash in those chips and get cash. All right. So you can't take those chips and play with them in other casinos, but you can take the cash you have and play with it anywhere else. You can also take the cash and just play it at the table in most casinos. So the dollar is the bank, the cashier. People are bringing their foreign dollars to the US, but it's on a ledger. So they're saying, let's say a country says, I need to borrow or I want to purchase something in US dollars, and they don't have a certain amount of US dollars in the reserve. And when I say dollars, I mean US Treasury notes. Usually short-term Treasury notes are what they're holding. Security backed notes is what they are holding in their reserve for US dollars. So it's not actually like paper dollars. you'll see a debit on one side and credit on the other side. So one account will go up, one account will go down, but the money's still all accounted for, right? So the dollars aren't exactly, like I said, they're not bags of money being moved from here to there. They're more or less ledgers on side of a balance sheet, one way or the other. Why would people pick one country as the reserve for dollars if that's how that works, if they're not real dollars? Well, people are looking for a stable country, a stable political environment, a stable financial independent system that operates not like some banana public type stuff where one person can make a decision about the economy, about everything. We have checks and balances, right? So also you want to have production here. You want to have places where people are generally safe. You don't want to have a lot of political and just turmoil in the country where the dollar is the reserve. We've seen a little bit of just economic detox at the beginning of this year and last year. And in those times, we've seen some of the dollars flee from reserves. We've seen people buying gold, central banks buying gold. The gold actually had risen above the dollar as the number one reserve currency in the world allocation. So, and that was just when this was around the time we saw threats to Greenland and just you have geopolitical tensions in Iran, we have Venezuela, or just think Russia, Ukraine, they're all kind of political things happening on the whole continent, Africa. So there are things just happening all around the world that we have to pay attention to. Israel, the Gaza Strip, there's just so much going on. Those type of things, when you have one place involved in all of them, those also can make your currency a little wobbly to per se. So the dollar, like I said, it's not bags of dollars, it's ledgers on the account. But you can't just keep printing dollars because if you just go into a place where you just start printing dollars, then people lose faith in your dollar. They lose faith in the amount that you can cover any debt that you have. It's also another big part of why a country would be picked as a reserve currency. Another thing we're talking about, tying into the dollar. A lot of conversations around affordability. So the 10-year yield, the 10-year mortgage, I'm sorry, the 10-year treasury. I'm watching 10-year yield. That's the one I usually pay attention to. The mortgages are more closely tied to a 10-year yield. They're actually tied to like to a 7.5-year bond yield. It's kind of how it would be. But looking at the 10-year, so the Fed has some control, but not really that much control on housing prices when it comes to the longer end. Fed's the Fed's points of control with that is that if the Fed should cut or if the Fed should raise rates to strengthen or weaken the dollar, that they'll make the proper decision. That's another term. That's another way that people have faith in the dollar as a reserve currency, that the Fed's not just lowering rates for no reason or raising rates for no reason at all. They're trying to control prices, price stability, and employment, full employment. That's the basis for what the Fed said their two main pillars are. They do that in a lot of different ways. 10-year treasury yield, like I said, that's like the center of gravity to all these things, though, because they're kind of tied. It's tied to housing mortgage rates, the 30-year. It's also tied to other long-term debt that companies make when they want to take out loans, because companies, large corporations, don't usually take out capital expenditures for 1 year or 2 year. They might spend it out 10 years, 20 years. So it may be expanding out much longer than that with with your 10-year yield. And 10 years been holding pretty steady around 4.2 here for a couple months. It went down into the low 14s, and I saw it go as high as into the 430s. But it pretty much hangs around in the 420-ish range. So with that, you have to watch it. Another thing to notice with the power of the 10-year treasury yield is if you see it move up, if it gets closer to like 5%, that puts a risk off environment. When I say a risk off environment, that means an environment where people see the returns that you're getting from fixed income, a bond, that's 5% with quote unquote no risk. You do have inflation risk, but that's a different video. We can I'll link a video to that in the description. But where you have inflation risk, so inside the bond, but people look for bonds to be their safe part. That's their safe play inside of what they have. So if bonds get up to 5%, and historically over the long run, stocks average, I guess it depends on who you're asking, 7 to 10% returns over the long run. But that's associated with risk. So if you're someone closer to retirement age, or even someone who's risk averse, and you see these bond levels come up to 5%, that makes people want to take their risk off, which means reducing their stock exposure and increasing their cash or safe positions. Alternatives have been really big this year as well. We've seen gold lead the way. Last year, gold was a big winner last year. We've seen gold take a huge moves already to begin this year. You are going to invest in some type of physical asset. I guess gold may be the one. I don't know. Silver seems to be very memeish. It's been up and down, just trading like almost like crypto at the rate that it's moving up and down. But gold's been a little more stable. If you already have gold, it probably wouldn't hurt to hold it. I don't know if I would go chasing gold at these levels. And if you bought gold last week, you might just want to hold steady for a little bit and see where things go, see how everything works out and levels out with the gold trade right now. But gold's a good store value. Gold didn't do anything for 2 decades, and then we saw a dramatic run in the last year. So maybe that run still has more time to go inside the cyclical rotation that we're seeing. So a lot. We still got a little bit more to go though. Once again, like I said, big shout out to Monarch Money. A great budgeting tool. It's very interactive. You can use it with you, with your family, with anyone that you want to interact with. You can share your personal budget with. I've used it with clients before where we jump in and I can just see where they're at, or I can go in and adjust to see tools, see where they're at. If you were going out to dinner, you need to pull it out and take a look, see where you're at with your daily budget, your monthly budget, weekly budget. Can I afford this? Can I not afford this? It's a good tool. So when you have a chance, just hop on, check out Monarch Money. There will be a link in the description down low. And yeah, that's with the Monarch Money. So another big thing that we've noticed is diversification. People hear you speak about diversification, but what exactly does it mean? You hear I was speaking about risk off a few minutes ago, and I was talking about bonds. Having bonds inside your portfolio would be a diversifier from having total stocks, right? If you have just stocks, if you have one stock, you have no diversification. You only have stocks. You have diversification inside your stocks, but you don't really have diversification inside your portfolio. So why does diversification work, and how should it work? Diversification helps you to hedge risk. It helps reduce the risk. So when I say diversification, you want to think of having the classic not having all your eggs in one basket. Sometimes you want to have money invested here, you want to have money invested there, but let's think more sectors, right? So you have your money invested, some money invested in the United States, some money invested in Europe, some money invested international total. And when we see, and what we've seen in the last year was international markets outperform US markets. So if you were totally stuck inside the US market, you would have missed a lot of returns. So diversification helps with that. Now, one thing about diversification is that you probably won't ever catch all of your returns. One example would be, let's say you invested in one of these high flyers that had great years in these last few years. Let's say NVIDIA. Say you only own NVIDIA stock for 23, 24, 25. You made a lot of money if you only own NVIDIA stock. But coming into the beginning of this year, when that stuff started to go down and crash, you would have lost a lot of money, right? Only on NVIDIA stock. Now, if you were diversified, you still would have made gains, even if you were just diversified in S&P 500 indexes of 25, 23, and about 18% in the last few years. And that's nowhere near what NVIDIA did as a single stock, but it's still a great return. And then when you see the move down that NVIDIA took, being diversified will help you so you're not absorbing so much of that blow. If NVIDIA is only 2% of your portfolio versus 100% and it goes down X amount percent, that's much less of a magnitude or impact on your portfolio. So we want to be diversified. We do want to have parts in there that catch the winners, but we need things that are, as we see right now, when people worry, they're diversified into gold, they're diversified into well, until recently, people had tried crypto. We saw crazy moves in that here lately. I think that has more to do with liquidity. That's for another video with Bitcoin and crypto. But diversification is key for long-term investing. And we're speaking about long-term investing here. We're not talking about day trading or hopping in to make an investment for a year. We're talking about long-term investing to see compound interest work and see your portfolio grow so you can be set up for long-term success. You can have options when it's time to retire or when it's time for you to take money if you need to pull a different lever. Speaking of which, one of the last things I want to talk about this evening today are the Trump baby accounts. Yeah, let's end on a positive note. For the kids, everyone loves the kids. Um, these were part of the One Big Beautiful Bill out that was passed in July. Uh, they actually go live this July 5th. What you need to do is you go on to the IRS site and fill out IRS form 4547. And so these accounts are for anyone under 18, but for children born from 2025 to 2028, they'll be seeded with $1,000 seed money in there from the Treasury, from the people, U.S. people. Once they have this money inside this account, they'll be invested inside U.S. investments. So once again, it's diversified inside of indexes, but it's not diversified globally. It's just inside the U.S. indexes right now. One benefit of this is you'll see how compound interest works. These accounts are set up to stay from birth until the age 18 before they can possibly even take their first withdrawal out. These are pre-tax accounts, which means when you do take your money out at 18, 35, whatever age you want to take it out, if you don't take it out at 18, they turn into retirement accounts like IRAs. So if you want to save this until you retire, some estimates have it if you just left it with $1,000 and never invested any more money in there, just let it go until your retirement age, you would have six figures. Some have it where some estimates have if you were to start with $1,000 and contribute to the maximum amount, which is $5,000 a year, that you would possibly have seven figures by the time you reach retirement. One of these babies would by the time they reach retirement age if they just let the money keep compounding and reinvesting in there. So it's powerful in theory. Like I said, they're pre-tax accounts. Another cool thing about these accounts is that we've seen a real big shift from the private sector to invest in them. We've seen Michael Dell and his wife, Ray Dalio and his wife, they're setting up funds to invest in for kids under the age 18. The NFL is investing inside where they're going to put seed money for their employees' children. JP Morgan, I think, is one of the companies. So you just see a lot of private companies. Bank of America, you see a lot of private companies coming in and kicking in to invest inside of this account. Some private donor in California, maybe just the city of San Francisco, said that they're going to donate $3.5 million to this cause. So it's a huge thing that's happening right now, and it could be generational and transformational wealth for these children and for these families. So all you got to do is go online, sign up. Like I said, if your child's born 25, 26, 27, 28, you will get $1,000 seeded money from the Treasury, from We the People. And there's also, like I said, private investors, private donors who are just investing money into the children of America. So that's a good initiative. It's going to help with financial literacy for children as they can see how the stock market goes up and down. It gives them more ownership, and later it'll give them more agency when making their decisions in investing, as they've seen how my money works, what happens when things go right, when things go wrong, and it will give them ownership when they walk into a place and say, I own a piece of that, I own a piece of this. That's a cool little feeling for a child to have. Financial literacy is a big hole that we have in America right now, globally. So any initiative to curb that plague is a great thing. It's a very good thing. Another perk inside of the Trump baby accounts. Trying to think. Yeah, so like I said, no, I think that's about it with the Trump baby accounts. Like I said, they go live July 5th. You can go online right now and fill them out. You can set them up, have them up for your kids, fill them out for the household, but they'll go live July 5th, 2026. Oh, that's a lot. Once again, I want to thank y'all for hopping on with me. checking out a little video. Hopefully you got some knowledge, something that helps you here. If it does, please hit like, subscribe, share this with someone. Leave something in the comments. Let me know what you want to hear Main Street and Wall Street talk about next week or next time. We bringing some guests on, so it'll be a good thing eventually. For now, you just get to speak to me. So let me know what you all want to hear. Let me know what Main Street's missing, what we're feeling. No inflation and prices, and there's just a lot of pressure going on right now. If you need a budgeting tool, check out Monarch Money. There'll be a link in the description. Once again, if you use that, I can be compensated. If you use the description I leave, but it's a good tool, and it starts with a trial, so you can have a 7-day trial to just check it out and see how it goes. Don't forget to cancel your trial if you need to, but if you like, you keep the trial going. That's one of the big things with budgeting is they don't have too many subscriptions that you don't use. I digress. So thanks, Main Street. Appreciate everyone hopping in, joining me tonight. We'll talk again soon.